All right, guys, welcome back for another video. Well, I do want to talk about give an update to the Bitcoin trade I'm in. I know I've been providing a lot of updates lately, but there's a lot going on in the market, and so sometimes there's not very much going on. Nothing really to do except be patient, and then other times in the market there's a lot going on, a lot to talk about, and I think this is one of those times where there's a lot of exciting things happening. Um, not just in the macro, but also like in the high time frame price chart, and just a lot of different volatility expressing itself right now. So I do want to talk about the other charts like oil, gold, the dollar chart, but I'll just start with Bitcoin for now. We're looking at the Coinbase Bitcoin USD chart. If we go to the monthly, you can see we can see the position I took down here from 17,430. I'm actively managing that as of right now. Um, trying to build a hedge so that when this thing, who knows when it'll pull back, but I just want to have the hedge there. And of course, I'm going to manage the hedge dynamically, but I need a hedge there so that if there is a pullback at any point, which we don't know when that would happen, that then I can, I have a little bit more optionality where I can pull the hedge and operate dynamically. And one of the reasons why hedging is favorable is because if you dynamically trade a position, which you should, but if you don't do it without a hedge, then what happens is your cost basis tends to creep up on that position. And it's one of those things that doesn't really matter on paper because you know it's not like the P&L on the position is any different if you manage it dynamically within the position itself or using a hedge. But it does change the cost basis, and that can mess with you psychologically. Whereas here I've got this great trade with a great cost basis of 17,430, basically from where the volatility came in the market down here, basically right this great entry, and a really favorable cost basis. And if I were not to use a hedge, then the more dynamically I manage it, the more that cost basis is going to creep upward, and that's going to mess with me psychologically, right? It's going to affect my ability to hold on to the position as a position trade as it's intended to be. But anyway, that's one of those things that, again, it doesn't matter on paper, but it's one of those things that in practical effects, it does matter. So anyway, I just want to kind of talk about the high time frames a little bit before I dive into low time frames. Basically, you've got this retest of the previous all-time high. If you were trading Bitcoin at all during this year and a half period, you basically have this consolidation, right? Where I know it doesn't feel like a consolidation because Bitcoin like crashed here to here and then had a massive rally up. So this doesn't feel like a consolidation, but it's basically spent a better part of a year and a half oscillating around the 45,000 level roughly. Um, and then it wasn't until this level got broken here and this range got broken to the downside that we started to see capitulation come into the market, and getting a capitulation down into the previous all-time highs, marked by realized losses really coming into the chart around here if you were to look at a capitulation metric. And if you were to ask a lot of people during 2021, like, would you buy Bitcoin if it retested the previous all-time high, which has never happened before, people would have told you that would have been an incredible opportunity. But of course, the same people that said that, when price actually retests it and capitulates down into this level, then the psychology of the market shifts and they no longer perceive it as a great opportunity, right? Even though the opportunity never changed, right? It's still a really favorable level, but when price actually gets there, then the psychology of the market changes and people here are looking for lower prices, and they actually did get lower prices. But the thing is, like, you get lower prices, and if it crashed to 20K and then, you know, people don't want to buy it at 20K, they want to wait to 16K, but then you get the crash to 16K, and those same people, they don't want to buy it either, right? They want to wait for 12K. And I'm sure that's a phenomenon you guys are familiar with, but it is something that kind of prevents people from taking advantage of bottoms of the market, right? Because they're always like grappling with the possibility that price could go lower. And in a sense, they're right. They're always right that price could go lower. But the way you deal with that is by, allocating risk accordingly, right? You don't want to ever be too overexposed, right? But if you have a low leverage position that doesn't represent a huge portion of your portfolio, um, you know, buying a little bit at the bottom or after a major correction is, of course, going to be beneficial. Anyway, so we've got this very clear breakout of the FTX highs, post FTX collapse highs. And I think, that's a very important level to keep an eye on because, um, you know, this area here, this range in here was where, well, we were capitulating all the way from here. So you basically have a scenario where the market was in a state of capitulation for basically, 8 months, a little bit, maybe closer to 6 months, roughly. And then you get the reclaim of this high right here. And let's see. Hold on, let me switch up my microphone situation a little bit. All right. There we go. Now, how am I going to manage this dynamically? Well, I got to go over to my hedging account, which you guys, if you guys saw my previous video, you know exactly what I was doing over there. I've got this hedge set up on Bitfinex 444. Now, really, what we're looking at here when we're looking at this chart is we've got this area right here, right? So this area here represents a level prior to, hold on, let me move this up a little bit. So you have this consolidation up here, this consolidation down here, and this expansive burst in volatility down here up into this level. So this whole area right in here can generally be defined as a gap or an area of inefficient price movement, where if price reclaims this level right here, it'll probably move very quickly to fill the gap. Of course, there is areas of price distinction along the way. There's areas in here you can't see as well on a weekly chart, but if you go down to a daily chart, you can see them a little bit better. But the idea is that this area right here is really the last resistance before Bitcoin sort of mounts a parabolic run up into this gap area up here. So that's the area where I would want to be building a short. And that kind of the idea for opening a short position right here is, so you have this area of historical significance over here, and it's also confluent with a run above a previous high as well. So you get the added benefit of any shorts who have stop losses or liquidations above here, you're running them while also running into an area of previous historical significance, which is something, this is really the ideal trade setup in my opinion, especially coming off this parabolic move like this. So you're inefficiently moving into an area of liquidity marked by stop loss orders that's also marked by a historical area of resistance. So this is the type of area where I want to be opening short positions. Now, if you watch my previous video, you know that I was opening short positions here, but when price reclaimed this high right here, I started pulling the short position, pulling the hedge and looking, for price to run above these highs up here, which it ultimately did, right? So I pulled the hedge from this high to that high and let price run up there. But, ultimately at this point, I do want to start building that hedge again, just because for the reasons I mentioned previously, this is an area where, of course, we don't know that price is going to stop here, but this is the type of area where price would generally, find resistance. And if it doesn't stop, at the very least, pause a little bit and give you an opportunity to maybe pull a little bit of the hedge off and take advantage of the volatility in a way that, where price isn't necessarily just going straight up, right? I mean, even if price goes to 40,000, right? I mean, it's not going to happen in a linear stair-step fashion, right? There will be micro swings and micro volatility within that expansive move. So the idea is just to play volatility, right, and play it dynamically, and always be open to the idea that you know parabolic price movement can retrace and often does retrace, and sometimes there can be different pulls on price from different directions, right? So you had this very, very impulsive parabolic move here. So if I'm looking at this chart, I'm looking for this area to retrace, but you know we also have a parabolic move into this area of interest, right? That could be retraced prior to this area being broken. um, we don't necessarily know which scenario will play out. So part of like managing a position well and being a good position trader is to try to take into account all the different scenarios that could play out, and to position yourself accordingly, so that really no matter what scenario plays out, that you've got some type of strategy for that. And a big caveat to that is you know when eventually at some point price will put in a top, right? And then when price starts putting in a top, you know you you want to start building that hedge a little bit more aggressively, right? Because that will be the scenario where that's the point where longs are probably chasing the market, and you can get a little bit of a washout. So as right now, my hedge is relatively modest compared to the size of the underlying position, right? You got this 1,039 Bitcoin position and 44 short hedge. That's relatively modest because price is breaking out, price is going, you know, moving pretty aggressively, right? It's not topping out yet. So the relative size of the hedge to the position is a reflection that price is still moving upward, right? It hasn't necessarily peaked, but still we want to be in the process of like always taking profits, always managing the hedge. It's always good to do, but you just want to of course have risk reflect uh, what kind of state the market's in. Anyway, so that kind of covers my idea on Bitcoin. Let's see. Let me see what I'm doing here. All right, so I need to manage this a little bit more dynamically than I am currently. So let's see. Pull everything off the chart. I'm going to want to pull a little bit of the hedge off right here at 22745, but we can call it 22777. I remember, it doesn't have to be exact, right? I mean, if we're placing a take profit order, we just want it to get filled, right? We don't necessarily need the ideal position. But, of course, if you're doing an entry, right, it's a little bit different because if you're doing an entry, you're a little bit more concerned about having the most favorable entry. So we've got this consolidation right here. Play the top, play the bottom. If you followed some of my previous videos, you know why these areas are significant. And then this area right here where things really started to break up. Mark off this area. So we got 21397. But remember, we're playing a take profit order. And if price is, further away from my entry, then I'm going to use order sizes that are a little bit bigger, right, in magnitude. Whereas I'm using 12 lot sizes up here, Bitcoin retraces further, then I want to use a order size that's order of magnitude higher than the ones up here, because that's a good way to trade volatility, assuming that it's not a way that adds risk, right? Remember, we're taking off a hedge. Also, we will also want to build the hedge as well. So let's see what we got here. So go on the 4-hour chart. So if we mark our levels on the daily chart, we got this area right here. May even need to go down to a 4-hour. Okay. So we've got this area right here where price broke this level right here. That's an area of significance right there. This is an area of significance as well. These areas right here where the volatility came in the market and propelled this aggressive move down. And then we also have the highs up here and the ultimate highs. But you get the idea. So let's go over here. All the way back over. So we already hit the first order that was right here, tagged it right there. But we also need to set orders a little bit higher as well. So let's see. We got 23533, 23533. Oops, too much there. You may notice that the sell orders I'm using are a little bit, they're a little bit higher than the buy orders on the flip side, and that's because I'm, playing this side of the hedge directionally short. So, I want it to be adding risk as price goes higher, and taking off profit as price goes lower, managing that hedge dynamically, but doing it in a way that is not not going to get in a situation where the hedge side of the trade could be start to become a long position. That's really what we want to avoid. Anyway, so we got our levels there. Prices move so aggressively from right here that there's really not a lot of position or a lot of areas to open a short position. But yeah, this is really kind of the way I'm looking at the market right now. I think we'll see how price interacts with this level. I do think this area is very significant for the reasons I mentioned before. The fact that you got price moving very parabolically into this level, into this area of liquidity above these highs and stop loss orders right there, into these historical price distinctions that are very significant. So we'll see. We'll see how price interacts with that level in real time over here on the right side of our chart, and see what kind of swings form on the right side of the chart and manage them accordingly. But yeah, more updates to come. So again, if